Well, good morning, traders, and welcome to followmetrades.com Saturday scanning session, looking for great trades. Patrick says loud and clear. Well, good. Glad you can hear me. Glad you can see me. All right. Well, again, welcome. I'm Dean Jenkins, and this is the followmetrades.com Saturday scanning session. I'm going to be looking for the next great trades for the upcoming week and beyond. So in the Zoom webinar platform, there's a couple things. There's a little icon to raise your hand if you want to. We may do a little poll later on, so make sure you can find that. Click on that, and it'll just show a little hand raise thing. And then there's also next to that, there's a chat feature. Make sure you can find that, and that's where you would ask questions, make comments as we go along. And I definitely want to make it interactive and have you ask questions and make comments. Later on, we'll be interested in looking at symbols that you are tracking, maybe trades you're interested in. Hey, good morning, Diane. So make sure you can find that chat box and go ahead and type in where you're calling in from, what city, what state, what country. We typically get people from all over the world, and it's fun to check that. Bob's from Tulsa, Oklahoma. Seattle, pretty close here. Lex from Squim. A couple Washingtonians. I'm here in Olympia. New Jersey, Malaysia. Karen, Northern California. DuPont, Barry. Well, the Washington contingent's here. Phil from Hong Kong. Kansas. Austin, Philly. Miami, Fort Worth, Connecticut. All right, Malaysia gets the distance prize so far. Arizona, Baltimore, Palm Springs, upstate New York. Happy St. Pat's Day from Florida. Hey, Georgia. Jeff from Newport. Hey, Jeff. Vancouver, Canada. All right. Looks like you guys got it figured out. And thanks for typing that in. Northern Virginia, Missouri, Houston. Usually we get a few more overseas. Usually get South Africa and all over Europe. So far, I just saw Malaysia. Houston. All right. Well, very good. UK, there we go, Ashley. Hey, Mac, good morning. All right, well, let's go ahead and kick off. Before we do, just a quick note here, a reminder that I'm not a financial advisor. I'm a trader, and I'm not giving financial advice. So we're going to be looking at trades that I like, specific entries. I'm going to give my outlook on the market. And again, specific trades. That's what we're looking for here. So I'll share what I'm doing, what I see in the market, my trade setups, trades that I like. But whether any individual actually places an order trade, makes any kind of investment, that's strictly each person's decision. Only you know what's appropriate for you, for your account size, your tolerance for risk, all the things that go into making good decisions in the market. So I share what I do. Each person makes their own decision. I'm not giving financial advice. Fair enough. I know several of you are invited here, and you may not know who I am, so I'll just do a quick intro. I'm Dean Jenkins, founder of followmetrades.com. I've been trading and investing for over 20 years. Really started when I worked for Intel Corporation, and they gave us incentive stock and options, and that was great. And they went straight up for a long time, and I got to see the power of that. I eventually got an MBA from the University of Washington, and I was a fundamental trader. You know, analyzing earnings statements and all that kind of stuff, all the financials, and very frustrating endeavor. Got mixed results. I totally gave up on the market in 2007. Just got frustrated with fundamental trading and the unpredictability of that. When a good company should go up and it doesn't, and a bad company should go down and it doesn't, it goes up. So I gave up for a while, stood out of the market, and I was just fortunate enough to go to cash right before the big crash. And that was just pure luck. But I couldn't stay out. Trading's too intriguing, and I do really enjoy it. So I got back in after the crash and got some winning trades. I actually bought Bank of America at $5. Then went up to 12. And what I learned was, even in a winning trade, you can be totally stressed out without a trading plan, because there that thing goes, and I'm like, well, should I take my profit? Should I get out? Should I let it run? Am I going to miss out? And you guys have probably all been through similar things. So I really got interested in technical trading in about 2010. I made a lot of mistakes. I went down a lot of wrong paths. I bought a lot of indicators and and training programs that turned out to not have much value other than teaching me. The trading's not easy. There's no magic answer. And, you know, it comes down to some real fundamental stuff. And no matter what, it's going to be hard work. And it is. But in 2012, I finally settled on my current trading system. So that's about 6 years ago, and started getting consistent profits. The key to that was really first giving up on looking for magic indicators that would just, you know, green light buy, red light sell, and understanding that you really had to study price and trading, and getting a mentor who would help me teach me, keep you on the right path, provide some accountability and really good information. 2015, I launched followmetrades.com about 3 years ago. So stay with me through this session if you want to get the most value. I'm going to explain the setups I'm looking for, because if I go looking at charts and say I like it or don't like it, it'd be good if you knew what my criteria was. I'm going to walk through my scanning technique, how I take, you know, the massive universe of symbols and narrow that down into a manageable list, and then look at some charts. And then I'm going to be looking for some great trade candidates, and I'd be happy to look after that at any symbols that you are interested in. And if we have some time at the end, once I have a couple good trade candidates, I'll go look. I really like trading with options, so I'll try to identify some good option contracts to trade those with. So again, stay with me. And if you're multitasking, of course, that's your choice, but you might miss out on some really valuable information. My trading resume, and I talked about starting trading with my current system in about 2015, and I've got the results posted here on my website. So this is my website, followmetrades.com. And there's my resume as I pulled my system together and started using it. So year on year, we're making some really, really solid results. I believe in complete transparency. So each of these buttons lists every single trade for that year. And if you click here, my results that I post on the website are audited by a third-party CPA firm. Because again, I believe in transparency, and what I put up in terms of numbers and results ought to be externally verifiable, and they are. Okay, so to be a consistently profitable trader, I think these three things are essential. And this is irregardless of what indicators you use, what setup you use, what time frame you trade. I think you need these three things in all trading. First, you got to have great trade setups with high probability outcomes, great reward to risk ratios, meaning the winners have the potential to be bigger than the losers. You got to have great risk management, and you got to have a predetermined method of managing trades once you get in. Risk management, trade management are different topics. Anybody disagree with that? Anybody agree? Raise your hand, push your button if you think those are kind of consistent things that are important in trading. Everybody got some hands up. And I'm going to explain these things here, how I approach all of these. Hey, lots of good, wow, a lot of hands up. Thank you. So we got some agreement. Good. In terms of profitable trading, let's talk about casinos for a minute, though. Here's some folks at the casino. They're at the craps table. They're all smiling. It looks like there's alcohol involved, and they're rolling the dice, and they must be on a good run there because they're all smiling pretty good. So going to the casino, if that's your thing, that's fine. Hopefully, if you go, you view it as entertainment, not as an investment or not as a way to make money, because in a minute we're going to show it's kind of stacked against you, right? So, you know, you go in and you play $100 maybe, and that's the cost of a dinner and a movie, and this is more fun for you. It's fine entertainment, right? Those folks are gambling, right? The folks at the table, they're gambling. Upstairs, there's some serious folks with green eye shades and watching some cameras, and they are not gambling, right? They are absolutely not gambling. And the reason they're not gambling, they're in business, is they control two variables. They control probability and they control risk, right? Like, you know, every table, every game on the casino floor, they do that. They control probability and they control risk. John asked, is sound missing? You probably can't hear me, but hey, John, I think it's working for everybody else. Maybe turn the volume up. So consider roulette. Seems simple. You know, roulette wheel has numbers 1 through 36. There's black, there's red. Half the numbers are black, half the numbers are red. And at first glance, there's even odds, 50-50 chance of either getting red, black, or even odd. And it's got a 1-to-1 payout. So if you bet $10 and you win you get $20 back, your original bet plus $10 win. Seems simple, right? 50-50. So here's a roulette wheel. There's a picture of it. Again, 1 through 36, black and red. But wait a minute, what are those green spots? We got 0, 0, 0. For American style roulette, there are 2 green spots, 0, 0, 0. What is up with those? They changed the odds from 50-50 to 47.5% win per spin for the player, right? Instead of 50-50, the player has a 47.5 chance of winning. Herman says, my video is blocking 1/3 of the slide. If you go full screen, it'll probably go, hey, let me turn the camera off. I think there'll be an icon anyway. But yeah, go full screen, and maybe it should just be a thumbnail then up in the corner. I certainly don't want my image blocking the important stuff. Okay. Green spots. So all of a sudden the odds got shifted, right? Now the casino has an edge. They have a 2.5% edge. So they're going to win 52.5% of the time, and that is absolutely enough, right? Over hundreds and thousands of spins, the casino is going to have an edge, and they know there's a mathematical certainty that they will win more than they lose, right? So they're controlling probability just by adding those green spots, and then they do something else, right? They ensure that they have a probability edge through the 2 green spots, and they control risk. And the risk is controlled via a table limit. So if you go into a roulette table or any other pit game, there's going to be a maximum amount you can bet. So you can't walk up to the roulette table and bet $1 million on the black, because there's a 47.5% chance you're going to win. And that would be a bad night for the casino if you were to win $1 million on a single spin. So they have a table limit. Maybe it's $100, $200, whatever it is. Different casinos, different pits have different limits. But they know that they're going to control. If you win, great, you're going to win your $100. And they know that over time, they're going to win more than they lose. And they won't have a big loser because they have a table limit. They're controlling risk. So why not be the house? Why not be the green eye shade people upstairs looking at cameras, sitting back in their chairs, and they're not stressed out, right? Because they're just making sure that the rules are being followed, nobody's cheating them, and counting money, right? Because they know hundreds, thousands of spins on the roulette table and at the craps table and at the blackjack table and at pie gow poker or whatever, they've got an edge. They know they're going to win more than they lose, and they're controlling loss. So why not have that in our trading, right? Why don't we approach the market the way casino owners approach their business and say, I know I'm not going to win every trade, but I want to know that I have an edge, and I want to know that risk is controlled so I won't take big losses. So the way we do that is by these 3 essential things that I talked about. First is having great trade setups that give you a high probability outcome, that give you an edge, right? And part of that is having a great reward to risk ratio, because there's something the casino can't do, right? They can't make their payout bigger, right, than their loss. They can't tell you that if you go play roulette and you lose, you bet $10, and if you lose, you got to pay them another 10, because nobody played the game, right? But we can do that. We can make sure that when we select trades, they only have the potential to win big. We don't need to take marginal trades, and we don't need to take trades that have only a 1-to-1 payout ratio. We can take trades that if they lose, say they'll lose $100, but if they win, they're going to win $500. We can just look for those setups, and we have ways of predicting that. And I'm going to show how I do it in a bit. We'll get to some symbols, Miles, a little bit down the road here pretty quick. We'll be looking at some charts and looking for some great trades. All right, so we want high probability outcomes and a great reward to risk ratio. So let me show you an example of a trade that we're in right now that has that. This is a live trade for my pick service, and let me get it teed up here. ENPH. So I mark up my charts the same way every time. I just put these horizontal lines on. So this light blue line, color is actually called cyan, is the price I got in at. That was my entry price. This red line is my current stop, and this green line is my target. So when I got into this trade, my stop was actually, I'll just drag it, was actually here, right there. And there's a reason for my stop placement, but it was there. But when I got in, you can see the distance from the stop to the entry is less than the entry to the target. So this is about 1.5 to 1. So that's not a, oops, my stop was actually here when we got in. Sorry, right there. I knew that didn't look quite right. My stop was here, right at the top of this gap. So this distance, entry to stop, versus the entry to the target, you see this is 2 or 3 times greater. That's, and how did I come up with this target zone? Well, it's these 2 blue lines. This is a Fibonacci retracement zone. This thing had a massive impulsive move down. We expect a retracement into this Fibonacci retracement zone. And I'm using the lower edge of it as a conservative target, right? So my reward to risk on this trade is, 2 or 3 to 1. If I win, I'm going to make 2 or 3 times more than if I lose. So that's what I'm looking for. And you can see, of course, so far it's a really nice winner. We got in at 386 and it's up here at 472. We're like about a 30% gain so far. And it's only about halfway through. We did take first profit on this. So that's what I'm talking about with a great reward to risk ratio. So a good example of that. So in terms of trade setups, I use a combination of 2 key things. I use Ichimoku Cloud and I use Elliott Wave. I call it East meets West. So Ralph Nelson Elliott developed his thing, his theory in the United States in the 1930s. Goichi Hisada developed Ichimoku Cloud in Japan in about the same time frame, about the 1930s. He was working on it. And so completely different studies, completely different analysis techniques, but when you use them together, it's pretty powerful. So let me talk about Ichimoku Cloud a little bit. A lot of people like moving averages. Probably the most popular indicator, on daily charts. A lot of people are using 200 to 50, the 12, the 8, whatever. Ichimoku Cloud is similar to moving averages. It's calculated differently. So the Tenkan and Kaijun lines are these yellow and purple lines. The way a moving average is calculated is you look back some number of bars in the past, and you take the average closing price and you plot a point, and then the next bar you plot another point. It forms a line, right? And it's the average closing price of some number of bars back in history. Tenkan Kaijun are the same thing. They're fast and slow, just like a 2 moving average thing, right? Where one's faster than the other, one's slower than the other. Ichimoku Cloud, Tenkan Kaijun are calculated by taking the highest high, highest low, and averaging them in the last period. It takes the extremes rather than the closing price, because just the closing price can kind of smooth out the extremes. But taking the highest high, highest low, taking the average gives you the price range, the full price range. And then it uses these lines and it ends up calculating this cloud area. And this cool thing about this is then it projects. You can see from the last price bar, we've got several price bars off to the right projected. And what it's projecting is future support and resistance. And so it gives you a zone rather than an absolute level like a moving average line. It gives you a zone. This shaded area is called the cloud, or kumo in Japanese. And it gives you a region of support and resistance. And I think that's better than an absolute line. So in an uptrend, it's saying price will probably pull back to the cloud, but not break through it. It'll find support at the cloud. And when it ultimately ends and then does come down through the cloud, that tells you, it gives you really good evidence that the uptrend has ended and a new trend down has begun. So that's important information as traders, right? To know where's a support area, where's a resistance area, and when has the trend ended. So it's really good at that. Again, projects support and resistance areas during a trend. So I said I use it in conjunction with Mark says, say last again, that the Ichimoku Cloud is good at predicting support and resistance and for telling you when a trend has begun, when price breaks, and when it has ended, when it breaks the other way. And Barry, no, these are not standard settings on the cloud. I have developed proprietary Ichimoku Cloud settings that are available in a course that I offer. My entire, not just the settings, but my entire approach to Ichimoku Cloud. Not the scope of today's presentation. I'm here to find trades, and I just want to explain what I'm looking for. All right, I use Elliott Wave, and I know a lot of people are already rolling their eyes. Bear with me. I use a very, very simple and very repeatable approach to Elliott Wave. There are some approaches that are ridiculously complex, and Elliotticians, the practitioners, can argue for days about wave counts and all that kind of stuff. The people that use the method that I'm using here, Bennett McDowell, who taught me, and then many of the students that I've taught, we don't argue because it's super clear and super simple where the waves are. All we're trying to trade is wave 3, which is a huge move, unmistakable on a chart, a correction after a huge move, and then after the correction's done, a continuation. Those are called waves 3, 4, and 5. Only 3 trade setups I'm looking for. So I'm looking to catch an early huge move. Afterwards, I want to try and trade the correction. And after that, a continuation of the original trend. We're going to look at several charts today, and you're going to see me say, too late. We've been in a long bull market, and several charts. If you go look at, Apple and Tesla and Microsoft and Micron and all the usual suspects, they're going to be at the end of wave 3. And by the time it's already developed and is already mature, it's too late to trade it for me, right? So I'm waiting for the correction if and when it comes. And if there's been a correction, then I want to trade the continuation. So I also use a little Dow theory to help confirm when a trend has begun and if we're still in it. So Dow theory simply says if you're in an uptrend, you will have higher highs, higher lows, higher highs, higher lows. And as long as that pattern continues, you are still in an uptrend. And in a downtrend, you'll have lower lows, lower highs, lower lows, lower highs. Right? Price does not move in straight lines. It moves like this in an uptrend. And you can tell when it ends when you no longer put in new highs and you break down through previous higher lows. And in a downtrend, when you no longer put in new lows, you put in a higher low and it goes above the previous lower high. Or you can confirm a trend beginning with a high, higher low, new high as it takes out previous highs. So having those definitions and rules, simple as they sound, are super helpful because, again, as traders, we want to know, has a trend begun? Are we still in it, or has it ended? Right? Those are important things to know about a trade, right? You want to go in if there's evidence that the trend just ended. And when there's evidence that a trend has begun, you certainly want to be thinking about getting in. So that's helpful information. And let's just look at a chart. I'll show you another example. I'll keep things grounded in reality here. Oops. So here's a long trade we took in my stock pick service. It's Momo, Chinese internet company. So I said that wave 3 is unmistakable. I meant it. Let me show you. Let me draw it here for you. So you look at this chart. You go, wow, there's a big impulsive price move. That's wave 3. It's unmistakable. After this happened, here was a correction. And by the way, it went exactly to Fibonacci retracement levels, these 2 blue lines. And look, using Dow theory, higher high, higher low, higher high, higher low. We are clearly in the next move up, right? This is the original trend. This is the correction. This is the continuation. In Elliott terms, 3, 4, 5. It's that easy, right? We don't need to overcomplicate it. That's exactly what, so I'm trying to trade wave 5. I caught it as it came above the Ichimoku cloud. We had a couple higher highs, higher lows. We had a nice price target. So we went long on the trade, and we've got a target on this up here at 50.75 in this target zone. The target zone is a Fibonacci extension zone between 61.8 and 100% Fibonacci extension. So I used a bunch of things in conjunction. I don't use just one indicator to qualify a trade. I look at the wave count first. Price action trumps everything. So price action, clear wave count, 3, 4, 5 starting, Dow theory, higher highs, higher lows. I'm above the Ichimoku cloud. I use the 200 moving average as a final confirmation. We're above the 200 moving average. Price oscillator, momentum is growing. Got a nice target zone, got a clear stop, right? Got a good reward to risk ratio. So everything's check, 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 check. All criteria is met. Okay, so that's what I look for, evidence to be stacked up for a trade. Again, no one indicator, no one set of criteria. It's the preponderance of evidence. And Ken's asking where wave 1 and 2 are. And I don't mean to make this a primer on Elliott wave, but there it is. There's 1, 2, 3. 1, 2, 3. Okay, let's get back to our slides. Where are we at? So I do want to get to some charts here pretty quick. So that's a little bit about trade setups. I use Elliott Wave, Ichimoku Cloud, and a few more tools to just confirm things. You need great risk management. Just like the casinos have a table limit so they control how much they would lose on a losing bet, we want to control how much we lose on a losing trade. And you have to, before you go into a trade, you just must. You must determine how much you're willing to lose on the trade. And the amount to lose, it's got to be a pain-free level, an amount that will not be a setback, right? Because if you lose half your account on the trade, it's going to be difficult to continue trading, and it's going to be demoralizing, right? And it's going to make you not trust your system. It's going to make you afraid of the market, all that kind of stuff. I use 2%. 2% of my account is, for me, a pain-free level. So that's not a position size. A lot of people get confused and go, oh, you only put 2% of your account into any given position. No. I put up to 15% of my account in any given position. But when I look at the stop versus the entry point, right, I then determine my position size using this formula, entry price minus stop price. That gives you risk per share. And then I take 2% of my account. So if it's a $100,000 account, it would be $2,000. And I take that difference between the entry and stop and I divide it into $2,000. So if you have if you buy something at $5 a share and your stop is at $3, that's a $2 risk per share. And if you divide that into $2,000, it would say go buy 1,000 shares, right? And 1,000 times $5 would be $5,000 position. Okay, so that's fine. That's less than 15% of my account. And if it hits the stop, then I'm going to lose $2,000 or 2% on the trade. I know some people are very uncomfortable having literal stop orders on their charts. They worry about market makers hunting their stops. So whether you place the order or whether you have an alert or a line drawn on your chart and take action when it's hit, doesn't really matter as long as you do it. As long as you actually get out at the stop. That's what's important. All right. Anybody here ever traded without stop loss, predetermined stops, and taking a fairly substantial loss and felt bad about it? And I first one to raise my hand. That's why I am so passionate and adamant about trading with stops now. Is, I've done it the other way when I was new. I've made mistakes, and you get into this cesspool, right? This psychological cesspool. Because if you don't have a predetermined stop, you get in, the trade goes down, you that's not too bad, it'll come back, and then it goes down some more, and you well, sure hope it comes back, and then it goes down some more, and you get to this point where you go, I can't close this trade, or I can't take that loss, it's too big, I can't realize that, and now I'm stuck, right? I'm stuck in this trade, I got capital tied up, I feel lousy. Have you ever been there? It's awful. It's just awful, right? So let's avoid that. Let's predetermine what the stop level is going to be, how much we're willing to lose on the trade, not how much we want to lose, but what are we willing to lose, and a level that would say, black and white, no decision, I will get out if price gets down to that level on my chart, and then actually do it. So that's good. I use Dow theory. Mark, psychological cesspool indeed. Bob says, been there, done that. Yeah. I talked a minute ago about using Dow theory. I place my stops in an uptrend at these higher lows. And as the trend plays out, I move my stop to these higher lows. Why? Because those are reality-based support levels. And when price goes through them, the trend has ended. And that's where I absolutely want to be out. Downtrend. And I just trail my stop to these lower highs in a downtrend until the stop gets hit. I take profit along the way, but I let the market take me out. Right? That way, the chart is telling me where the legitimate stops are, and it's taking me out of a trend when it's over. And I think using fixed stops, 5%. If it goes down 5%, I'm going to close the trade. Or if it goes down $100, I'm going to close the trade. I think that's a mistake, because those levels could absolutely be within the average true range, right? Because price moves in higher highs and higher lows and higher highs and higher lows and lower highs. And if you're arbitrarily getting out at 5% or 3% or whatever the number is, right, it could be within this normal movement. You get stopped out and you're still in an uptrend, and that would be sad. So I use actual price movement to determine my stop levels. Okay? And there's my formula for position size. And then the third thing you got to have is trade management. I kind of just alluded to that. And that's trade man. So you can get into a great trade setup with an edge. You can have great risk management. You can still lose money. So you got to be able to manage a trade. And it's taking profit at the right times, adding to the position strategically, staying with a winner for as long as possible. And I should bold that one, exiting the trade at the right time. So the key to consistent profitability, it comes down to math. Remember I said you got to have an edge, right? And you got to have a high reward to risk ratio. And the high reward to risk ratio enables a high payout ratio. So the payout ratio is the ratio of the size of your winners to the size of your losers. If you don't have a healthy payout ratio of like 2 to 1 or better, meaning your winners are double the size of your losers, if you don't have that, then you have to have an 80 or 90% win ratio to be profitable. And getting an 80, 90% win ratio is super hard, and it's a lot of pressure. But if you have a 2 to 1 payout ratio, if your winners are double the size of your losers, so if you lose $1,000 on a losing trade, but on average you make $2,000 on a winning trade, guess what? What does your win ratio have to be profitable? 50%. You only have to win half your trades. That takes the pressure off, right? If you can make your winners double the size of your losers, you only have to win half your trades to be a very profitable trader. We want to win more than that. We try to win more than that, and we typically do. But boy, that just takes the pressure off. And the only way you get your average winning trade to be double or better your average losing trade is first to pick trades that have a high potential, and then next, stay with the winner. You got to stay with the winners and let them run. I'm sure you guys have heard this, right? Cut your losses early, let your winners run. So cut your losses at the predetermined stop and let the winners run. And it takes incredible discipline. I see a lot of traders who, we get into a trade, it pops, it's up a little bit. They go, yeah, close it, take the profit. It may feel good in the moment, but you are totally undermining your trading system when you do that. Because if you're taking profit, short profits, you're probably going to stay with the losers until they hit the stop. And now you're at best, your payout ratio is 1 to 1. And if you're a 1 to 1 payout ratio, that just means you're a break-even trader. Your broker's pretty happy with you, but you're not going to be consistently profitable. You got to have a high payout ratio, and the only way to get that is to pick good winners that have potential and then stay with them. Let them run. Let them run. Do I use closing price for my stop? Nope. Just DJ, anytime during the actual session, if price hits my stop, I am out, because my stop is placed at a strategic level. Like you can see on Momo, I talked about putting my stop at higher highs and higher lows. Higher high, higher low, higher high. My stop is here at the higher low. If price goes below that at any point, I want out, because the up pattern has been broken. It has been voided. It's probably heading down from there. So I just want out if it touches that price during the regular session. I don't act on before market or after market data, but during the regular session, if it hits the stop price, I am out. So again, stop trade management. So I get in. Here's my entry. Wave 3, new trend. Right? We got a higher high, higher low. Prices above the Ichimoku cloud. Go ahead and take an entry. Initial stops at the low. As price plays out, trail my stop. Take profit up at key reversals. Get out when that trend is over. Let it correct, and then trade it again. These are real veils when we traded. We traded wave 3, let it correct. Traded wave 5, made profit on both. Just keep trailing the stop up and let the trend tell you when it's over and take you out. Good stuff. All right. So those are my trade setups that I'm interested in. Now it's time to go look for some trades. So I'm going to pause, catch my breath, take a drink of coffee, and then we will jump into trades. All right, Daryl's asking, are these mental stops or in the platform actual stops? Yeah, I touched on that a minute ago. So some traders don't like to have actual stop orders. They, stop market orders. They think the market makers are out to get them, hunting stops. I don't necessarily buy into that. I've talked to some market makers. They disagreed with that thesis. They said it's not true. But each person's got their own beliefs. That's fine. And whatever you do in the market, you have to be comfortable. You got to be comfortable with it. Don't do anything that's going to keep you up at night, right? So whether you draw a line on a chart, set a price alert to text your phone, or you have an actual market order, it doesn't matter. What matters is you get out of the trade at the stop. If that price level's hit, that you exit the trade. Whatever method works for you to accomplish that end is what's important. Just the fact that you do it, though, not second guess it. Put your stops in the right place, right? Be thoughtful about where the stops are, and then if they're hit, get out. If you find yourself second guessing, it hits a stop and go, well, let me wait and see if it gets better. It's a bad habit. It's a bad habit. It will undermine your results. I'm going to get to those symbols in a minute, Tom. First, so here's how I scan the market. I do a big picture review. So what's going on in the overall market? And from that, I create a thesis about what I think is going to happen next. And I may narrow it down to a sector. But ultimately, what I want to do is narrow it a big list down to a manageable list, and then go look. At the end of the day, it's hard. You got to do some work. You got to look at charts, and you scan. So let's do a big picture thesis here. Let's look at the overall market. I'm going to look at the S&P 500. There's something interesting about it. There's always something interesting about the market, right? So you guys all know early February there was a bit of a correction. Nice sharp move down in the S&P 500. It pulled back up after that, pulled down a little bit, pulled up. We got a classic kind of double top here, right? Price went back up to this retracement level, wicked above it, but could not close above it. And this is appearing like a pretty significant resistance level. And you can see the Ichimoku cloud remarkably projected support all through this uptrend. What's new? Price broke down through it. Price went into the cloud, it's above it, but look how thin the cloud is at this point. The thinner the cloud is, the weaker the support is that it's predicting, right? And it was fairly thick out in these areas, right? And it held up pretty well. So my thesis is, I think there's a chance that we're either going to channel for a while or break down and take another leg down, right? At least down to the 200 where it found support before. So I'm not looking for dramatic new highs at this time, either a sideways channel or down. So I'm looking primarily to the downside. Now I'm in a handful of long trades already. That's part of my bias. I got some good long trades on. And so I'm kind of interested in balancing that and looking at the reality of price action here on the S&P 500. I'm kind of interested in some short trades. So that's what I'm going to be looking for today. Mark, what percent retrace? I'm not sure which one you're asking about, Mark. Which retracement? This retracement from this move here, by the way, was just under 76.4. If it would go above 76.4, then it would no longer be a retracement. Then maybe that's what you're looking at. Yeah. So this was 100% of the big move. The retracement went above 61.8 but stayed under 76.4. Pretty interesting. Okay, so I'm looking for some bearish trades. And I walk through what my trade setups. I'm looking at Elliott Wave, Ichimoku Cloud, Dow Theory, right, in conjunction with each other to find either the beginning of a new trend, a correction to an existing trend, or a continuation after a correction. 3 trade setups that I'm looking for. I'm not interested in chasing existing mature trends up or down. So Yeah, Niraj, zigzag, 4A, 4B, 4C. I don't use those, man. I keep it super simple. Wave 3, wave 4, wave 5. Super simple. Bob is asking, can I do a scan of the stocks in the S&P 500? I absolutely could, and I've done it before. But today, I'm going to scan first the Dow 30, the Dow Industrials. I'm going to scan the Dow, and then I got a sector that I'm interested in. That I'll show you how I kind of narrow it down to a sector. But let's start by looking at the Dow. Okay, so here's 30 stocks in the Dow, and I've written a custom indicator. I've got Ichimoku cloud, so I'm interested in shorts that are below the cloud and longs that are above the cloud. But as I said, also kind of pay attention to the 200 simple moving average. And I wrote a custom indicator here that just tells me in radar screen, this table, whether price is above the SMA or below it, how far it is, and how many days since it crossed. So let's look here. I'm interested in shorts. So I'm just going to sort real quick. Now I got, what, out of 30 stocks in the Dow, we got about eight or nine that are below the simple moving average. A couple of them just crossed. That might be totally interesting. So I'm going to go through these pretty fast. What I've done, I've got this linked to my chart. So if I click on the symbol on Disney, it's going to bring up the Disney chart. There it is. And the Disney chart, I start looking at about 18 months worth of data on a daily chart to see the big picture pattern. I'll get to those, Mickey. I'll get to your symbols in a minute. Chris, on the S&P 500, it's not wave 4 yet on the S&P. It's not wave 4. It hasn't gone down nearly deep enough to be a wave 4 correction. So Disney is a lousy chart. It's a good example. People that don't like Elliott wave, part of the reason they don't like it is because they look at a chart like Disney and they go, well, I can't figure out the wave count. And the reason is there isn't one, right? It's a chaotic chart. There's no wave count here. Elliott wave does not apply to every chart you're going to see. And the trick is being able to, train your eyes to see the patterns. And when they're not there, to move on, go find something tradable. And for Disney, maybe the happiest place on earth, but the chart isn't. The chart is lousy. Let's look at the next. So I'm just going to use this list, and I'll just keep clicking on these as we go. Okay, DWDP. They must have changed their ticker. This is DuPont. Dow DuPont. Okay, remember what I was saying, right? I'm looking for wave 3, and wave 3 is easy to spot, and it's actually 1, 2, 3. There's this huge move, unmistakable, right? But look, we got a correction. We got a lower low, lower high. It looks like we're trying to go down to lower lows. We might have a tradable correction here. That didn't take too long to find. And the first thing I'm going to do is see how far it would correct to. Really simple. Here's the Fibonacci retracement. We expect it to retrace between these two blue lines. That's a Fibonacci retracement zone, 38.2 to 61.8. This is a candidate. That didn't take long to find. So Dow DuPont, DWDP, that's a short candidate. I like it. It's we had a big wave 3, wave 4 starting. We're below the Ichimoku cloud. We're below the 200. We got some negative momentum if you compare this to this, and then decreasing positive momentum if you compare this to this. It looks pretty good, actually. So, wow, we found one. Next on my list here is GE. No surprise that GE would be under the 200. Well, I'm certainly not interested in a short on GE, and I'm not interested in a long either. I mean, this is a beautiful impulsive move. It popped up off the bottom, but it's done this a couple times, right? We need a high, a higher low, a high, a higher low, breaking the cloud. If it does that, this may be in a correction. It's nowhere close. Nothing there. Next up, J&J. That indicator in the lower panel is called the OWL, Optimum Wave Locator. It's an enhanced price oscillator. It's pretty cool. I like it for measuring momentum. J&J, so it had a wave 3, a wave 4, a wave 5. we had watched this before. It played out kind of just as expected. After wave 5, there can be an A, B, C. This would be A, B, C. I don't trade ABCs typically. This one could be big. It may be tradable. It's reversing right at the 200. And we could also trade this on a 60-minute chart. So really cool thing about price charts and these analysis techniques is they work on any time frame, and these patterns are fractal, meaning they appear at any level of magnification. So we could trade this as a wave 5. This would be, we could do this on a 60-minute chart, which I just switched to. Come on, man. So this would be wave 3. Clear down. This is a perfect wave 4, right? 3 down, 4 up, and we could be looking at a 5 on J and J. If I get my Fibonacci extension bar, bars, prices, we may have a nice price target on J and J down here below 119 to 109 once it breaks the cloud. So there's a potential 60-minute chart there. So let's put an asterisk there, make a note of that one. Yeah, on the daily chart, I use the 200 simple moving average, not the exponential. And the only reason I'm using it is because I know it's the most popular indicator on the planet. Everybody else is watching it and maybe taking action on it. So I want to kind of be aware of that level. Let's keep going. On the Dow here, we found a couple candidates already. It's kind of useful. McDonald's. What about McDonald's? Same kind of story as DuPont, right? Big impulsive move up, correction happening, right? It had the February thing. It went back up to the 200. Looks like it could be reversing. We could actually do a 60-minute trade on this one, just like we did J and J. 60-minute chart, try to catch wave 5. So that's got potential. That's interesting. Yeah, we got 3 candidates right off the Dow. That's not bad. So let me show you an approach to sector analysis as well that I like to do. There's my homepage. Here's a really cool website that if you're not aware of it, you'll thank me for pointing it out. This is FinViz, F-I-N-V-I-Z, Financial Visualization. And check out this heat map that they provide. They got a bunch of other tools that are just astonishing and free, and they've got ads that pop up too, which is not so astonishing. But here's a cool way to get a quick look at sectors is you look at ETFs, and let's look at the last week, right? See how powerful this tool is? I love it. And now we got this heat map of all these different sectors and ETFs and ads popping everywhere. Beautiful. I see some red areas, right? You know, Brazil, I don't know if I want to trade Brazil, Latin America. But look over here in the financials. This is pretty interesting. We got XLF, which is a really, really big financial ETF provided by SPDR. And we've got FAS. That's a 3X. I don't trade leveraged ETFs, but a KRE is pretty interesting. So KRE and XLF, you know, if we look across those in basic materials, but last week this financials, after kind of in the back of my mind, I know, wow, they've been running up a long time. If there was some weakness, maybe there's some trades emerging, some short trades emerging in financials that I'd want to go ahead and take a look at. So that's just a thesis at this point. I can't trade based off that, but it would take my attention to a particular area of the market and go look at some trades, right? Go look at some charts and see if there's anything there. And so I did a little pre-work last night, but if what's really cool, like XLF and KRE, what's really cool here is if you go to the website, not that one, this one, and like SPDR, if you go look at any of their, sorry, I got a contractor doing a little work in the background if you hear noise. Anyway, to go look at any of these, they'll give you, when we were looking at XLF, they'll give you the holdings. right? In a spreadsheet of all things. You can download an Excel file of all the symbols that are in there. And you can get that for SPDR, and you can also get it for this other one, KRE. So I went ahead and did that pre-work and got those symbols, and I've already loaded them into a custom list here in TradeStation. So I didn't want to bore you with loading symbols and spreadsheets and all that stuff. So symbol list, I created this last night. Custom symbol list, financials 316. So there are those two ETFs. I've loaded the symbols from both of them, and let's see if we can find some trades. Chris, if you're working off a shorter time frame on the chart, generally trade in the shorter period. My advice is whatever time period you find your setup on the chart, whether it's daily, weekly, 60-minute, 10-minute, trade that time frame. I use other time frames to confirm, maybe if I'm on a daily and I want to see what the bigger trend is, I'll go look at the weekly. But wherever my setup is and on my stop placement, that's the chart that I'm going to manage the trade from. Wendy just logged in. Hey, well, thanks for being here, Wendy. Yeah, this is recorded. Barring any technology failures, I'll be able to have this recording available within an hour or two. You're welcome. Mickey, you got your hand up. If you have a question, type it in. I'll do my best. Okay, so we've got the data loaded, all the symbols loaded, the indicators are calculated. So I'm just going to do a quick sort. Price position. Remember, I'm interested primarily in short trades. Robert, is there a recording of this? Hopefully. I am recording it, and if it does not get corrupted or fail or anything like that, I'll have it available in a few hours. Okay, so we got some symbols here to go look at, and it's pretty cool. How are we doing on time? We're pretty good. So I'm going to pull this off to the side, and I'm going to go pull up a few charts now. So the Chubb group. Well, this looks very similar, doesn't it, to DWPP, DuPont that we looked at earlier. Robert, how do I gauge an excellent level of liquidity within those symbols gathered? Yeah, volume is the key indicator of liquidity. And like I'm looking at Chubb here. So on Friday, it traded 2.6 million shares. So I'm pretty sure it's got good liquidity. That isn't something I check before I actually take a trade. Is I go look. I'm not a fundamental trader. I don't care about their earnings. I don't care about who the CEO is or their product roadmap, any of that stuff. I care less. Those things are important, but they're all reflected in current price, right? The market has absorbed and acted on all that information. All known public information is reflected in price, and that's really what matters. I go look and make sure, when's earnings going to be announced. I don't really care what their earnings are, but I care that the announcement's going to be tomorrow. I don't want to trade into a big event that will introduce volatility. And if there's a pending M&A, there's a pending bankruptcy, I don't trade into known volatility. Okay, but if we got a clear runway out in front of us, I'll trade it as long as it's got high liquidity, right? And bid-ask spreads, I try to get the best entry possible. If there's, with these highly liquid stocks, the bid-ask is usually pretty good. Of course, it's way off because the market's closed here. And I primarily trade with options anyway. So I just want a liquid market and a good liquid options market as well. So that's, so this looks good in terms of a potential short. We would check the potential profit. It's a little thin. Again, this would be a good 60-minute trade, perhaps. Mark kind of set that up at the beginning with a review of S&P 500, where we're at, and what my outlook is on the S&P, why we're looking primarily at short trades, and because I've already got a handful of longs in my current portfolio and want to balance those out. Okay. So Chubb looks like a decent. We would probably trade that on a 60-minute. Let's see what else we got. AIG. Here's another one. It's kind of like Disney, and again, good kind of case study on maybe why Elliott wave frustrates people because they're trying to get a wave count and there is none. This is just a messy chart. It's chaos. And I can see it in about 2 seconds. Go, there's no trade there. Not interested in AIG. Let's keep going here. AIG was bad, but HIG is pretty interesting. And again, it looks like it's starting a bearish move after a big impulsive move up. It's down through the 200. We could trade this on a 60 with a 3, 4, and then a 5. So that's interesting. And so we've gotten 1, 2, 3, 4, 5 trade candidates here. I'll take a few minutes now and I'll look at the ones you're interested in. So Mickey's got, I'll take 1 or 2 from each person, right? I can't go through all of them. But VZ, Verizon, right? Yeah, this is kind of like AIG. VZ, it's too chaotic. It's not an orderly market. There's not a clear wave count. It had, look how it swings above and below the 200. I avoid charts like that are just too, they're moving at random, and I don't have an edge. And we talked about, the whole casino thing. We want to have an edge, and there's not one in a trade like that. Okay, that's my take. CHK. Chesapeake Energy. So obviously look at this move down from 1685 down to, got as low as $1.63. We would be looking kind of like on GE, looking for it to finally put in a bottom and get going. But as long as it's putting in new lows, it's below the Ichimoku cloud, below the 200, it ain't happening yet. So definitely don't want to try and short it, right? It's been a long downtrend, and it's too early to try and go long. So nothing there for me on Chesapeake. NVIDIA. So I had, given the kind of qualifier earlier that we would probably see a lot like Micron and Microsoft and NVIDIA, a very long mature uptrend, and it's still putting in new highs. So this has been going on, for over 2 years, and it's gone from, under $40 to $250. Marvelous trend, marvelous trade, but it's way too late to get in. Way too late to get in for me, for my trading method. I would be looking at the correction, and there's no sign of it beginning yet. So for me, too late to go long, too early to try and go short on NVIDIA. Several people typing in Netflix. We'll get Netflix, VLO from Larry. Yeah, I want to look at Valero. I've traded Valero in the past. Maybe a correction beginning. So here's the big impulsive move. It's trying to correct. It looks like so many of the others that could be a potential short. It's a little bit early, but and you got room down to the 200. I would probably trade that on a 60-minute chart. So that's worth looking at. Netflix. Of course, same story. Not only has it been a long trend, it just went parabolic. Right? You can see the angle of the trend radically increase here this year. Probably get a short-term pullback on this, but we don't know how far it's going to go. Probably not going to get a correction on the full trend. So too late to go long, and I don't think there's a good enough short. So great trend, great company, but not tradable for me at this time. Man, the symbols are rolling in. I will never get them all done. I apologize, but there's only so much time. Simulations Plus. So this is setting up for a correction. I would be interested in the short under the 200 SMA. Not yet. Volume seems a little thin, so that might keep me out. 91,000 shares on Friday. I like, several 100,000 at a minimum. So that's probably going to keep me out. Shiv, TK. Maybe it's been channeling forever. It looks like, big dramatic drop. Channeling forever. So it would need to break this channel and really get going, and it's not doing it yet. It's under the cloud, so nothing there at this moment. BP for Stanley. correction is starting. This one's a little chaotic, and it's an ADS. So BP is, of course, a British company, and so ADS is why there's always gaps between each day. Yeah, not the best. We found some other candidates. Celgene for Joseph, bearish trade. Well, who wished they shorted it there, right? This thing obviously in trouble. Drug company, of course, probably had some bad news. Yeah, too late to short. And I wouldn't have been traded this. This thing's too choppy. I look for more orderly markets. Yeah, nothing there for me. Okay. Tom, I know you typed these in earlier. I'll take a look at Walmart for you. You've been very patient. So Walmart has corrected into the Fibonacci retracement zone and has found support at the 200. So the next move might be long on Walmart. If we can get a high, higher, low, new high, we want to see momentum shift to the positive. But the next move is probably up on Walmart. And Plug Power, what a super interesting company. Maybe getting ready for a wave 5 long. Here's pretty choppy, but here's the move up. Here's the perfect correction, higher high, higher low. It's dancing around the top of the cloud. If it can break, we probably got a nice long coming on Plug Power, and it could really explode. So that's interesting, Tom. Yeah, one more. I'm going to look at Citigroup for Stanley, and then I'm going to do a wrap here. So Citigroup could be getting ready, big, impressive, bullish move like the rest of the financials, and some consolidation and maybe getting ready to go short. I want to see it break the 200 at about 70.91, and if so, we got a nice correction zone on Citibank down here below, down 65, call it to 55. So that's pretty nice, pretty good. So yeah, lots of trading opportunities. We called several out. So let's just recap here. I think to be consistently profitable, you got to have great setups with high probability, great reward to risk ratio. You got to manage risk. You got to manage your trades, right? And earlier I did a little poll, and people were universally in agreement that those things are all important. So how many of you are excited? I've got several trade candidates here. We got 5 I found in my scanning, a couple more that I made notes of from your ideas. Anybody excited about some of these trades? Maybe getting involved in them, but maybe unsure about how to act on them, right? Maybe you feel a little bit like this guy here, like, wow, that was a ton of information, kind of drinking from a fire hose, right? So what I'd like to do is, if you're interested in these trades and in my method, what I got going on, I'll go over a quick special offer that related to what we just talked about, how you can participate in these trades with me. Okay. Again, need great trade setups. You got to have risk management. You got to have trade management. And I provide all of that in my stock options pick service. Hey, you're welcome. Shiv, David, Gents, Willis, do I trade ETFs? Yeah, I include those in my trading. I think they're a good thing to mix in with individual stocks. Really what it comes down to is a great setup, great reward to risk ratio, right? And making profit. So what would it cost if we have returns year to date at about, a $100,000 account, about $2,000 a month is average. We're averaging about 25 to 30% per year over the last several years. With the pick service, you get 4 hours of detailed trade consultation with me, because you have a live chat session every week. You get one-on-one consultation when you first sign up, and then of course ongoing education. This stuff all adds up to several $1,000s, and I offer that in my pick service. All those things, great trades, risk management, trade management, consultation, ongoing training, complete support through the trades, and it's not going to cost you thousands of dollars. For folks attending today, you can take a trial of my stock and option pick service for 30 days for just $37. And let me get you a link to do that. I'm going to put it in the chat box. And it renews after that at $97 per month, which is a discount from the list price off the website. But go ahead and hit this link, and you can go find out more about it. right? I've got some information on a web page there and a little video if you want to watch it. So my stock and option pick service, you get 1 to 2 new trades each week. So the ones we looked at here, I'm going to continue analyzing those and be publishing the best of those to my subscribers tomorrow, and be ready for the open on Monday. We'll be taking some new trades. We're in, I think, 5 trades now and in profit on several nice ones, and there's still new entries. So if you sign up now, you're going to get not only the new trades, but the existing trades that still have plenty of profit left. Let's see, we have a live chat session every week where I go over the charts. You get real-time updates via email and or text alert. If you want to opt into text messages, you get a free consultation with me when you sign up. Website, I got tools on how to calculate your trade size, right, to follow my risk management guidelines. So quite a bit comes with the stock and option pick service. You get signals on new trades. You get a consultation with me, a weekly webinar where we go over the trades, answer any questions, do some training. You get text alerts. You get tools for calculating your trade size. And for each trade, I publish the information. All the analysis takes place on the chart. So I publish an entry price, a stop price, and a target price for the stock. So you can trade it with the stock. And I also select a corresponding option contract so you can trade it with the option, either or, whichever one you like. We manage the trade the same way. So I just hit that link. And so anybody that's interested in that, you can go check it out and sign up. So that's really what I had planned to cover today. We did find 5+ good trade candidates. This is recorded. I will send a recording link out once it's rendered and uploaded and all that kind of stuff. Wally, what option strategies? So my option strategy, I go long calls for a bullish trade. I go long puts for a bearish trade. Those are the simplest, most profitable, lowest risk strategies. We can argue about that, but I've done exhaustive research, and butterflies and spreads and condors and all that kind of stuff. They have their place, but if you have a directional trade like I'm trading, if you say, for example, there's a high probability we have an edge in like this trade that we're in right now, Momo. Momo, we have an edge, and there's a high probability that this thing's going to go up to 50, 75. Not a guarantee, but a high probability. The highest profit, lowest risk to trade that is with a long call, with the right expiration date and the right strike price. If you go buy it out of the money and that's expiring in a week, you're going to lose all your money. You lose 100% of your money. If you buy the correct contract, you have the highest profit, lowest risk. And I give the exact contract for that. You are welcome. Tom, does the offer include the trading room? No, this is the stock and option picks, different service. So the trading room, again, a little different focus for folks who are available during the week. If anybody's interested, I'll give you, there's a link for a trial to that. You can get into the trading room for a week for $7. You can check that out. Shiv, nice comment. Shiv says, hey, he was in my trading room a week ago, bought the ENPH. He's up $900. He's going to subscribe. There you go. Right? Yeah, it was a nice trade. We're in that one, and it's doing very well. This is a trade that we published to the subscribers. Again, we got into ENPH at 386. Week and a half later, it's up here at 472, and we got a target up over 590. This is a bullish setup on ENPH. Very bullish. Yeah, Bob, we're in that one. We are in it. It got triggered yesterday. Okay, so just to reiterate, offer that I'm making now, $37 for 30 days, 100% money back guarantee, by the way. If I want customers to be happy, right? And if it's not a good fit for you, most people like it, they stay, but it's not a fit for everybody. I've got my trading method. Some people have other beliefs about the market. they want to try it, that's cool. So take the trial, spend a few weeks. If it's not your thing, just let me know. Send me an email, send me a call. 100% refund, no hard feelings, no questions, just okay. But most people stay and like it. So I got the link posted for that trial in the chat area. Or if you like, you can do the text thing on your phone, text trial to that phone number there. That'll be super high tech, and you'll get the links. So there's the link to go ahead and sign up for a trial. And I'll just hang out and answer any questions you guys have about the service. But other than that, hey, thank you. Thank you for spending time on a Saturday with me. I know your time's valuable, especially your weekends, and I'm honored that you would spend it here. I hope you found it valuable and useful, and you're glad you attended. I'm certainly glad you did. Thanks so much. And again, I'm just going to hang out and answer any questions about the offer, about the service. Bob, hey, you're welcome.